Everybody knows that Bitcoin's limited supply is a positive thing, right? There is actually a chance that we might all be wrong and that Bitcoin is actually becoming too illiquid. Today, we're going to be looking at a potentially controversial topic of Bitcoin maybe being too illiquid. So right now, where better to start than the BTC hodl waves chart on lookintobitcoin.com. Now, this is looking at the percentage of all Bitcoin held by different age bands. So for example, this dark purpley color is all the Bitcoin that's been held on wallets for at least 10 years, which is a fairly substantial portion of all BTC. What we can actually do is just remove a certain amount of these age bands. So for example, everything from 3 months below an example, and we can see that the amount of BTC that hasn't moved in a 3-month period is almost 90%. Now, once we take into account that the circulating supply of current BTC is 19.5 million, which is already quite a lot considering the hard cap it'll only ever allow 21 million BTC on the network. So to consider that nearly 90% of this doesn't move in every 3-month period is quite a lot of BTC that's just stagnant, I suppose. We can also remove this and look at just that hasn't been moved in a 6-month period. And again, this is exceeding 80%, so less than 20% of that 19.5 million BTC is just moving on a half-yearly basis, which is considerably less than pretty much any other asset. So a lot of people have considered this to be one of Bitcoin's most bullish fundamental factors, and I'd like to state that I also believe that too. I'm just doing this video to maybe start a conversation, start a topic of discussion. And a good way that we can really display that this is actually quite a bullish thing for Bitcoin's price appreciation is looking at something like the money multiplier effect, which basically takes into account the amount of Bitcoin that is for sale and how that any incoming capital into the market actually increases the market cap of Bitcoin much more substantially than just the capital inflows, just due to the illiquid supply. But one thing we need to consider is as Bitcoin is becoming less liquid and potentially seeing more exponential price increases just due to the reduced amount of capital that's actually required to increase the market cap of Bitcoin, we can look at something like the CME BTC futures contracts, which over the past few weeks and months have grown rapidly in interest. Now, these are paper Bitcoin, meaning they're derived from the price of Bitcoin, and they are simply there to mimic BTC to allow people to bet on price increases or decreases. Now, these aren't backed by any Bitcoin. These are just purely, again, mimicking the price of Bitcoin. The issue with paper BTC is, like we said, it doesn't actually inject any capital into the market. And if we just go onto the volume chart, we can see here for these CME BTC futures, we can see here that the trend is definitely to the upside. So why does anyone actually trade these Bitcoin derivatives if they can buy actual BTC, which will likely result in prices increasing more, giving them more profit? Why don't people, again, just buy real Bitcoin as opposed to these paper BTC? Well, for one, it allows them to utilize leverage. And we can see here that this Bitcoin funding rates chart here on Look Into Bitcoin shows the actual funding rates of these derivative contracts that leverage traders experience when they actually buy or sell these derived futures contracts. So, for example, we can see here when this spikes considerably to the downside, it means traders that are in short positions or betting on the price of BTC going down actually have to pay funding rates. They actually have to pay a set amount at certain intervals, whether it be 1 hour, 8 hour, 24-hour intervals, just to keep their positions open. And the same is true for the upside. Once we see exceptionally high positive funding rates, it means that people in long positions actually have to pay funding to keep their positions open. But traders are more than willing to do this because of the leverage, which allows them to vastly increase their exposure and risk to the market because they believe that they can potentially increase their profits exponentially. And this growth of interest in paper BTC trading, these derived Bitcoins, actually may, again, becoming a hindrance to actual network adoption. We're just on the logarithmic scale of Bitcoin price and active addresses. If I just remove the BTC price and we look at the active address 7-day average, we can see here that over the past few years, this has definitely slowed down in its increase. We can see that even the peak we set here in 2017, the peak we set in 2021 was actually only about 50,000 new active addresses higher on this average, and this hasn't really grown notably for a number of years now. And this might partly be due to the fact that people now have a fear of missing out. We can see here that Bitcoin, especially over the longer term, tends to very much trend to the upside. So maybe people aren't willing to ever part ways with their Bitcoin, which, like we said, decreases the liquid supply. But if this potentially comes at the expense of incentivizing trading and investing using paper BTC, then it doesn't benefit the network at all. In fact, it's a detriment because we can now allow capital to actually bet on price decreasing. And as the illiquid supply continues to decrease, the opportunity for market manipulation to take place actually probably increases quite substantially. If you look over the past 1 year of BTC price action, you'll see a much more common pattern occurring. And this is this big spike we get to the upside, stagnant price action, and big spike to the downside. Now, these are sometimes called BART patterns, but these are essentially possible by large market makers, potentially whales, manipulating the market, just due to the fact that the amount of spot BTC, the actual volume of actual BTC that's being traded, is continuing to decrease. So if you have a substantial amount of BTC, you can potentially buy, increase the price, take a short paper BTC position, then profit on the way down as you sell your underlying BTC. And we get these pretty frequent manipulation patterns in the Bitcoin market where price can increase rapidly and then decrease rapidly for profit incentives for those that have a large amount of BTC holdings. And again, there is also the consideration that if you are potentially a considerably wealthy investor wanting to potentially accumulate or gain exposure to the crypto markets and want, for example, 1,000 BTC, if you wanted to actually buy underlying real BTC, 1,000 of them, that would cause such a disruption in the market, such a huge capital inflow, that it would likely increase prices so exponentially that your average entry price would be considerably higher than what you'd originally anticipated. This is just due to the slippage, and when you actually buy a certain amount of Bitcoin, if there isn't enough BTC to actually fulfill your order, price will increase until there is. So we can actually see on these much larger Bitcoin holdings wallets that the trend over the past few years has definitely been to the downside, which is in a little bit of a contrast to the smaller wallets. So just comparing this 1,000 BTC addresses holding to something like the 1 BTC addresses holding, which we can see go on a near constant uptrend. If you have a substantial amount of capital to invest, you might not want to influence the price of BTC so heavily. So you might be, again, more incentivized to invest in paper Bitcoin, which won't have a substantial impact on the underlying price and will still give you that exposure to the price increases as Bitcoin probably trends to the upside due to its illiquid supply. There is also the fact that if you just look at something like the number of millionaires globally, there's tens of millions of millionaires. And like we said, there's only a couple million BTC that are actually liquid and available to be purchased at any given time. So if all of these millionaires wanted any exposure to BTC, if they haven't already, to begin with, they can't even buy 1 BTC. There simply isn't enough. So why would they buy actual BTC when potentially there isn't even enough for them to buy, when they could potentially buy paper BTC, see the same profit percentages to the upside, and again, without having any real exposure to the market? Especially then, as they could also potentially short the market and profit on the downwards bear cycles. Also, if you haven't already, please don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your #1 source for Bitcoin information. So just to summarize on this slightly more controversial video, nearly 90% of Bitcoin hasn't moved in the last 3 months, and over 80% of Bitcoin hasn't moved in a 6-month period. And like we said, this will likely result in higher BTC prices due to the limited supply, especially with the halving event coming in around 6 months' time. The capital inflows required to vastly increase the BTC market cap and subsequently the price reduces massively just because the amount of BTC available to buy continues to decrease. But we do need to acknowledge that it may result in even more paper BTC and potentially more market manipulation. Like we said, just due to the fact that you don't want to have a substantial impact on the BTC price when you're a potentially large-scale, sophisticated investor wanted to gain some exposure to the market. So paper BTC may actually be a more favorable alternative. And the fear of missing out may actually stop people from ever using or selling their BTC who already own it. As we could see by the amount of active addresses, the psychological impact of not being able to own as much as you previously did may actually be a deterrent that's preventing people, like we said, from using Bitcoin as the peer-to-peer money that it was originally developed to be. So like I said, controversial topic. And I would also like to state that I do not believe that Bitcoin should remove its hard cap. And I think that this is actually a bullish factor for limited supply going into the future. But we need to start conversations. We need to discuss these topics that potentially one of Bitcoin's currently most bullish factors one day could actually hinder its growth and adoption. If you liked or maybe even disliked this video, anyway, please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know what your thoughts are. Do you think Bitcoin is potentially becoming too illiquid? Do you think it already is? Do you think it will be in the future? Or do you think everything I've said is irrelevant and Bitcoin is ultra bullish and is going to reach tens of millions of dollars a coin, regardless of my opinion? Either way, let me know. I look forward to reading and replying to all of them. As always, thank you very much for watching, and I'll see you in the next one.